Hello, everybody. Welcome back. It's Thumper with Financial Options. And today we're going to be talking about one of my favorite strategies, the Poor Man Covered Call. I really love this strategy. It allows anyone to take a little capital and control bigger stocks than they can normally do and make money off of that. So, this is also a great strategy for smaller accounts. So, short little introduction to it. It's a bullish long term strategy. You don't want to be selling this up on stocks you think will go down. Look for stocks that are near 52-week lows that you think might be oversold or will go up in the course of like 2 years in the version I use. This is a stock replacement strategy. So you're using option contracts to set up the covered calls instead of buying 100 shares. And it's more capital efficient, allow you to get a greater return on your money. The strategy is very similar to selling a covered call. So if you've done that, you already know most of what this is all about. You just got to learn a little bit of the nuances about how they work together. The strategy is also called a vertical calendar spread. There's some other names as well. If you're talking to your friends, you might not want to call it the poor man's covered call because they think you're broke or something. But in case you hear someone say the vertical calendar spread, it's just another version of the poor man's covered call. All right, and the way I like to set this up is I like to buy a leap that's like 2 years out, where the extrinsic value that I'm paying is low. And don't let the word leap confuse you. It's not anything special. It's just a long dated contract. There's not anything special to sign up for. Just a long dated contract. Other people will run poor man cover calls on a shorter cycle. They'll buy a call 3 months out. It costs less to do, and they just have less time to make it a profitable trade. I'm willing to give up a little bit more money to secure a position that gives me a longer timeline to make it profitable. And then once you have that, you're just selling calls against the position on a shorter cycle. And the reason why this works is because your long dated contract, the time decay is going to be small or very minimal, and the shorter dated calls are going to be bleeding theta pretty quickly. If you ever looked at that theta decay chart, you can see like the last 45 days of a contract, theta increases exponentially, whereas the leap will be kind of still flat. You might lose like a buck a day on holding that position. So in terms of the poor man cover call, the leap just simply replaces the stock, lets you control 100 shares to sell the cover calls against, but you're using a lot less money to do it. And this acts just like a cover call. If you know how to run a cover call, you already know most of how to run the strategy. Leverage. So why this strategy is really awesome is because it allows you to leverage up even without margin. If you ask people how they build their wealth, one of the things you'll hear is people doing it through real estate, and that's because they can leverage their money. They'll put 20% down to get a house, rent that out, use the equity to get another house by putting 20% down. This is kind of similar the way I like to think about it. So you'll be hearing me refer to like poor man cover calls as like subletting, and we'll get into that a little bit later here. Say you wanted to sell some covered calls against Apple. When I took this screenshot, that would cost you $12,461 to do. But if you're doing the leap at the 85 strike, it would only cost you $4,100 to do. When you sell the call, it doesn't matter what you're securing it against. Like, would you rather secure a $200 call you're selling against 4,100, or would you rather sell it while using up 12,000? That's kind of why these are awesome. You can use a small amount of capital to control shares to get a higher return when you're selling those covered calls. And just to kind of show you what you could do, although I wouldn't recommend it going at least like 3, is for the price of controlling 100 shares of Apple, you could control 300 by using option contracts, which means instead of selling one covered call, you could be selling 3 covered calls. So instead of collecting $200 on one position, you can collect $600 on 3 positions. Now, what's the loss potential? Is this more like scary to use? And the answer really is no. With a leap, the max loss you can have is the debit you pay to enter the leap. So let's say that Apple goes down to 80. If you bought the shares, you're down $4,400. But if you bought the leap for 4,100, like that's the most you can lose is the 4,100. And that's because if Apple is below your strike price, you're not going to exercise your contract because you'll just be realizing an extra loss. So just you let it expire worthless. And even then, because it's out of the money, like there still could be 2 years left on the contract. You have extrinsic value left. So to estimate what that would be, I'd like to use this as a good guesstimate kind of thing. We're saying that the price is $80, which is $5 below our strike price. Which means if we look at the opposite end, what would be $5 out of the money, and that has about $15.90 of extrinsic value. So really, if the stock price went down to 80 like the day after you sold this, you would only be looking at maybe like a $3,000 loss, because that intrinsic value that you lost has now become extrinsic value. So you'd be at a less loss than you would if you had the shares. It's similar to like if it goes down to 50, you're still participating 1-to-1 on the shares, but you had your max loss defined by the debit you played when you entered the position. And because we're selling these calls, because we're buying these calls so deep in the money, you pretty much participate in a 1-to-1 ratio when the stock goes up. So like you're not giving up those gains unless you have shorts against them already that get breached. Probably the biggest risk I think that people have when using the strategy is like they're just over leverage. The example I showed before, like if you just replace 100 shares with one leap, you're using less capital, and you kind of limit your downside risk because your max loss is defined, whereas holding the shares, you participate all the way down to 0 if it was to happen. But if you start taking the extra money you have left over to buy more leaps, smaller drops, you're exposed to losing like 3 times as much money if you have 3. So just be careful about how much you leverage. You need to keep some capital on the sidelines to manage some trades. Just because you can sell 3 for 1 doesn't mean you should. Maybe just go 2-to-1, or when you're starting out, just do a 1-to-1 replacement strategy just so you can get used to using it. And PMC like subletting, yeah, that's really how I look at it. You're buying a contract that gives you the right to control 100 shares, and then you're using that contract to collect premium by selling shorts against it. So you're renting this contract, and you're renting it out to someone else by selling your new one. So in order to really understand and get confidence of why this strategy works, you need to know what makes up premium. And if you've seen my other videos, you've seen this picture before, intrinsic and extrinsic value. Extrinsic value is simply the volatility and time value. That's the extrinsic value part. Intrinsic value is why this works. So intrinsic value is the value that the option is worth at expiration. And so that simply what that means is when your contract is about to expire, it has value left, and that is the difference between your strike price and the current price of the stock. And that's because you can exercise your contract to buy it at your strike price, then immediately sell it at the current higher price. So like that value is always going to be there, because if you can't close it, or sell to close the contract, you can exercise it and then sell the shares to get that money. So that's why it's worth that much. To calculate it, it's the current stock price minus your strike price. Going back to the example we had, if Apple is trading at 130 when it comes time to when your leap is about to expire, you would turn around and you'd be able to sell it for 4,500, because you could exercise at 85, turn around and sell the stock at 130, or you can simply sell to close the contract at 45 each, and knowing that you paid 41, you just made money off this leap, in addition to whatever short premium you collected along the way. Here's an example at 110. If the stock lost money, you'd still have a profit, or that option still has value. You can sell and get 2,500. So really, in this scenario, you only paid, what was that, like 1,400 to have this position that made you money for the 2 years. And if the stock traded flatly and it never went up or down, or at least it ends at the same price that you entered the trade on, you can see what you would be worth. And the difference between this and what this is the extrinsic value, or the rent you pay to control that share, essentially. So PMCCs are like subletting. Basically, the intrinsic value is your security deposit. You're putting that up at, when you first buy the leap, and you'll get that back mostly if the stock doesn't move when your contract comes to expire. The extrinsic value that you're buying the leap for is basically your rent. Like when I put that out, I assume that's just gone. And I hope that over the course of the 2 years, I can sell enough covered calls against it to make back that rent value and then some. So my goals with PMCCs, you can do these on shorter cycles if you want to. I like the idea of buying it 2 years out and then selling covered calls on a monthly cycle. And eventually, if you collect enough premium from your short calls, it could become a free position that is just, you could continue selling covered calls against and making more money. I think when you do the math, it tends to be like 8 to 14 months of like a monthly cycle. You should be able to collect enough premium that you would have made back all the money you paid to enter the position. I found that most of my PMCCs get closed early because my short gets breached, so I could close those for a profit. And I'll go over a couple of those in a second here. All right, so to set up, you try to find a call that is deep in the money that you think will not get tested. Look at like the daily year chart and get below like the lowest level. You want a contract that is low in extrinsic value, and that tends to happen around delta of a 0.8 or maybe a higher 0.85. And the reason why you want that high delta is because if the stock goes up, you participate pretty close to owning 100 shares, so the intrinsic value of your leap will go up as well, and that'll offset losses if your short goes in the money. So that's why you want a delta that's pretty high, at least 0.8 is what I would say. All right, so here's an example I did. This is Walmart. I bought 2 contracts worth. It cost me $10,000, which is still less than your cost to secure 100 shares of this to sell a covered call. I was able to get 3. I sold 3 short calls against it. So first I sold one expiring about a month out, collected $73 per contract. I was able to close those out on a dip, make $120 off of it. Turn around, sold another monthly contract on it. This one I actually let expire, so I collected the whole thing. Then I sold another one, and this one, I think Walmart shot up moderately high. I decided to close the position because it became pretty profitable. And what you can see is over the course of this trade, my leap gained value, so I gained $2,600 through that. Or $2,100 through that. I gained an additional $450 through the cover calls I sold, making a 26% return on the cash over a 2-month period. Tell me where else you can get that return on a seemingly safe strategy. Here's another example with AT&T I did. I actually paid pretty heavily for this premium. Some people followed me on this trade afterwards, and they were able to get in for $6 a contract. So they saved a lot more compared to when I entered. But I was able to keep up because during that time, I was selling cover calls against the position, lowering my cost basis or my leap. And again, in the end, you can see another trade that ended up being profitable. Made some money on the covered calls, made a little bit on the leaps, 15% return over 2 months. On this stock, I think over here is where my short got breached. I think AT&T went up to like $31. So I actually had to pay more to exit this position. I lost $372 on here. But as a result, the leap contract gained similar value. So I was able to close this for a profit. And that's why having a deep or a high delta leap is essential, because if your short gets breached, your leap should participate in the upside and cancel out those losses. I'll go over one more example before I actually show you the process of setting one in. And here's one I did on snow. I actually started with 2 contracts at 114.50, I think it was. And snow ended up going down lower. I had 2 more contracts, which brought my average position to 104. that shows you right off the start that I was going pretty negative on the leap to begin with. Uh, I waited actually 2 months to sell covered calls against it because it was supposed to be a short-term play for me to catch a little bump. Turned out that wasn't the case, and eventually I decided I wanted to start attacking this position, make it a profitable position. So I turned it into a PMCC. So when I set this one up, it was not originally meant to be one, but I like to set it up in case I need to turn it into one later. So that's why I buy high deltas, leaps when I'm buying premium. Here you can see I got through 2 cycles, made a little money. The third time, the stock moved up to 230. I was able to cut the massive premium, which would in turn lower my cost basis by like $10 here, or 10.4. And if you're looking at the upper right corner here, you can see like it's still profitable even though the leaps are negative. And then 2 days later, Snow shot up to 240, and I decided, you know what, I'm in a profitable position. I want to get out of this. I had a little too much money invested in this position, so it was just something I wanted to get out to lower my exposure. You can see how much this changed in just one day. I went from the leap being negative and the cover calls being 5,000 to kind of like turning a split. Overall, made a 9% return on this position as well. But what I think is interesting is I held the leaps for 4 months and only made 2,000. And the shorts I sold against it, I almost made 2,000, but it's only half the time. That's why poor man cover calls are awesome. All right, so now I'm going to go through the entire process of setting one up in Thinkorswim. And I'm going to do that by first clicking on demand to trade in the past. We're going to set this to March 8th. And the first thing I like to do is look at the 52-week low. So if we're doing Coke, I want to be under $36 or so. I don't want to deal with managing a leap that's fallen out of the money. So that's why I like to go pretty low here. And go to trade. Head on down. Let's go 2 years out. So I want to be below 36. So I'll be looking at like one of these contracts here. Delta, you want to be at least 0.8 usually. One's kind of ridiculous, but that's also because the spread is pretty wide here. I can see that this has like low extrinsic value, so I'll probably go with the 3250. So I'm going to go ahead and buy one of those in this virtual account. Now, I would normally sit here and go with the limit and try to get someplace above mid, but just for the sake of this video, keep it fast. I'm going to do a market order. Send. And so I bought this for $19.40. Next step I would do is come over to my Poor Man Cover Call Tracker, right-click the sheet, duplicate, rename it to KO, and start putting in the information that we have. So today in that is 3/8. You got January 2023. The stock is actually 51.8. Yeah. We sold the 3250. We paid, how much was that? 1940, I think it was. Commander. Yeah, 1940. We haven't exited yet. We'll say we paid 69 cents. Alright, so to secure this position, we basically paid 2,000 bucks. Now, why I fill this out first is I like to see what my short strike break even would be. And normally I would fill this in hypothetically before I buy the stock to see if I'm selling above 51, like how much premium am I actually collecting for this position. So when I say above that price, go back over here. I normally look for like 30 days out, but for this example, I'm going to shoot 46 days out. And while looking at these, you're trying to see how much premium you can get. I think 53.50, 75%, it's a covered call. If we get breached, we have room. We're above our break even, so we get money from the intrinsic value of the leap. So this is actually what I'm going to go with. I'm going to sell one of these Again, normally I would sit there and play with the limit to try to get a good fill, but for the sake of this video, I'm just going to do a market order. And we collected 70 cents. Very nice. Go ahead and put that in. We did the 53.50 one. That 75, I think it was. I don't really care about the probability of the money. 3.8, 4.23. We know the price of the stock is 58, or 51.80. So this is what I have now. Here's my PMCC. It's all set up. Now the great thing about Thinkorswim is I can sit here and fast forward to that date, and I'll do that right now. So we're going to go to the date of expiration. It's going to take a second to come up. And what we're going to see is, over the course of this trade, our short call gets breached. And that's good. That's what I want to show you, how you'd manage if that happens. So, come on. All right. So here we are. Our call that we sold is now in the money. It's actually worth someplace around here. At the same time, we can look at our leap that we have. You can see that the bid and ask are up slightly as well, and that's because Coke has gone up. So our leap contract that we bought is worth more because the stock is worth more. And the contract that we sold, unfortunately, is worth more because it got breached. Now, in this case, you have two things you can do. You can try to roll this forward, roll it up and out to try to defend your PMCC. But I think, why would you want to? Because what you can do is turn around and close the position. So I'm going to buy this guy. So we paid 98 cents for that. Let me go over here and stick that in. And then if I go back and close our leap, $21.15. You can see in this 45 days, we just got a 7% return on this play, where our short call got breached. So it wasn't even a perfect PMCC, but we still made money off of this. And if you don't believe this spreadsheet, we can come over here and you can see we started with $100,000 and now we're up to $100,147. So we made basically 147 bucks. And that's the poor man's covered call. So that's basically it. The poor man's covered call. You're just buying a leap to control 100 shares. You're selling covered calls against it with the hope that you can sell more of those on a monthly cycle to make more money back than it costs you to secure that position. That should take it between like 8 and 14 months if you have a stock that trades pretty flat, which means you have 8 months where you're selling covered calls against a position that is now essentially free. Pretty cool. If this got you interested, go ahead, hit that subscribe button, share it with other people. In the video description below, I'm going to leave a Google Doc that has like 10 or 11 other resources that you can watch to learn more about this. If this got you interested, like, please go watch those. Once you get through all that and you have this video, you should be pretty well equipped to be able to run this strategy successfully. All right. Thank you for watching and happy trading. I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.